To start, we will be starting with ZenBTC, bringing more Bitcoin to Solana.
Hey everybody, my name's Adi. I'm one of the co-founders of ZenBTC. Look, I'm just going to cut to the chase here. We need more Bitcoin on Solana. Solana's trading roughly around 100 billion FDV. We fundamentally think that it's going to be $1 trillion asset in about 5 years. But the way we really get there is by having and driving Bitcoin growth on Solana, natively embedded into all of the top tier DeFi protocols that exist on this wonderful ecosystem. But this is actually a very interesting chart here. Look, just a year ago, you really had no Bitcoin volume on Solana. And over the past 6 months, you've really seen an explosive growth of BTC being used as a yield asset or as collateral within Solana's DeFi ecosystems. Look, this number is at 4.1 billion right now. To put it in comparison, Ethereum did roughly 30 billion of Bitcoin DEX volume in April of 2025. We fundamentally believe that Bitcoin will be the main asset as collateral on Solana, and this number will probably maybe 20x in the next 2 years. So this is a lot going on here, but I just wanted to show the evolution of security for a lot of these wrapped assets, wrapped Bitcoin. And we really started out here on the hot wallet side, moving into the mobile wallet, hardware wallet, multi-sig, centralized MPC. And what we're really, my mic go out? All good. But what we're really focused on is providing a decentralized custody network that is powered by MPC, but really is decentralized from a validator perspective. So within our decentralized custody network, we have 8 institutional validators that each secure 100 billion plus in stake, and they each hold a shard of the private key. The main point here, and I want to stress this, is that the current security solutions that are underlying a lot of these wrapped assets are not sufficient for future wrapped Bitcoin products that are going to launch in the coming years. So what's really stopping institutional Bitcoin from coming to Solana? As I mentioned, we believe we can achieve 500 billion plus of monthly volume on Solana, but there needs to be a standardized solution, a security solution that a lot of these wrapped Bitcoin products can launch on. Right now, the security framework is quite fragmented. MPC is a great form of security, but the user has a burden to really trust a lot of these wrapped Bitcoin products out there. One uses multi-sig, one uses MPC, one uses a centralized custodian. There's no real standard for users to trust in terms of putting assets into a wrapped Bitcoin product. And what we're really focused on is launching a decentralized custody standard, similar to how a lot of cross-chain assets implemented the OFT standard. All wrapped Bitcoin assets or wrapped assets generally should adopt the DCT standard, which is Zenrock's decentralized custody standard. And it works in a very easy way and simple way. Users lock Bitcoin on the Bitcoin L1, and through our custody layer using MPC, we mint a representative of that asset on Solana. So once an asset is a DCT, trust is natively embedded into that asset, and that's what we're really focused on. The way we're doing this is by launching our own DCT called ZenBTC, coming to Solana in this week. We're decentralized to start. Right, we're a DCT token focused on promoting decentralization for wrapped assets. We're Solana first, and I think this is very important. We had a lot of conversations with Ethereum applications across the board when we initially started this journey, and let me tell you, it was actually really difficult to even integrate with a lot of Ethereum apps. It was very slow. You had to go through governance. You had to talk to this guy to approve your proposal. But working with a lot of the DeFi protocols on Solana that you see today, it was very easy to go about an integration, especially since we're bringing Bitcoin to their network, and that has the largest TAM in crypto. And I'll also mention here that ZenBTC is yield-bearing. Yield is generated from our MPC network and fees, and it's also generated via restaking protocols, primarily starting out with Drift. So really, to sum it up, we're here to bring more Bitcoin on Solana, and we think there's enormous potential for other wrapped Bitcoin assets to leverage our security standard moving forward. So I'll start off with, leave it to that. But thank you so much for listening, and hope you guys have enjoyed the event.
I mean, yeah, we want to see more Bitcoin on Solana. Bitcoin's the best asset. For our next presentation, we will once again be having Reflect come to the stage, moving from Bitcoin Fi to stablecoins, another hot narrative. So without further ado, introducing Leo.
Let's go. We got the. So, I'm Leo. I'm one of the founding member and head of growth and partnership at Reflect Money. Today, we're going to talk about a problem that we are really passionate about. Everybody loves stablecoin. We're so excited about them. But fundamentally, they're broken. So year to date, more than $6 billion have been minted as stablecoin with a TVL growth of 140%. This is great. As I said, everybody loves stablecoin. Everybody loves cheap transfer. Everybody loves fast settlement. But all that capital actually sit idle in the wallet of the owner. So this is great for all the intermediaries like Circle, Tether, Paxos. But the on-chain economy needs productive asset on-chain. So we asked ourselves, what it would look like to have a bank that is fully on-chain, that is transparent, and it works for you 24/7. Hopefully you got that. Okay, yeah. We call those assets strategic stablecoin. They're financially intelligent dollars. So you pick a strategy, you mint a stablecoin, and the yield that is generated by the collateral directly flow into your wallet. You can become Circle without intermediary very, very easily with Reflect. So you can just deposit your collateral, wrap it, mint a stablecoin that is always redeemable for the dollar value of the collateral. Then you wrap it very, very easily with just one click, and automatically all the collateral will generate yield for you. What happens when you need liquidity? Very, very easy. Since it's everything fully on-chain, with just one transaction, you can unwrap it and re-get your all the collateral that you put into the strategy. Because at the end of the day, what Reflect is an insured, fully on-chain money that generates yield while they're waiting to be spent. I guess, yeah, our first strategy, USDR, is finally live on mainnet. You can join the waitlist by scanning the QR code, or if you think you want to become an ambassador, maybe you're really interested in DeFi, or maybe you want to deposit more than 100K, or want to embed this in your app, in your saving app, come find me after the other talks. Thank you for listening.
For our final presentation, we have Exponent, one of the hottest new DeFi products. Yield trading is a sign of a maturing DeFi ecosystem, and Exponent's success, I think, is a sign of the Solana DeFi ecosystem maturing. They launched a month ago and have already seen over 75 million in TVL. So without further ado, give it up for Thomas.
Awesome, thank you. Hey everyone, my name is Thomas. I'm one of the co-founders of Exponent. And today I'm going to walk you through Exponent, what we've been working on, and also the trend we're seeing within Solana DeFi. So if you look at DeFi historically, things started with models that were prioritizing liquidity over efficiency. And that made sense back at that time because when network when protocols and blockchain started off, there was no users, no sophisticated players who could participate and essentially come in and start deploying capital. So protocols had to prioritize liquidity over efficiency. And so what we've seen in the early days is essentially one-size-fits-all models that were trying to put everyone under the same bucket, which led to a lot of inefficiencies in the market, a lot of unused liquidity across dexes, high spreads, expensive inflation models, and also essentially not taking into account user risk profiles. And so over time, we've seen DeFi becoming more sophisticated. So as soon as protocols started having more users and we started seeing more activity within this ecosystem, protocols started to improve upon their models, making sure they could become more efficient and essentially move away from those one-size-fits-all models. So we've seen protocols like Uniswap essentially moving away from what they had, which was essentially a position shared by everyone, where people were providing liquidity and sharing the same parameters than anyone else, and they came up with concentrated liquidity. We've seen other iterations like order book-based models like Phoenix. On Solana, we've also seen users becoming more sophisticated. A good example is Meteora, where you have users being educated about market making and providing liquidity for meme coin pairs in Solana. And that has been the same for credits. We've seen that with Morpho, Euler, Loopscale more recently, trying to enable lenders and borrowers to become more flexible. And so we're really seeing this trend of DeFi overall becoming more mature and more larger participants looking to enter the space and deploy capital. And a good example recently has been asset managers. We're seeing for the first time kind of businesses trying to generate revenue on-chain and selling services. So you have companies like Gauntlet, Re7, and Drift Vault has been a very good example in that regards, where essentially those managers can bring more activity for Drift and sell their expertise to on-chain participants who are now not able anymore to perform the strategies which are becoming more sophisticated. And so as the space matures, we're seeing a broader set of participants with more capital, institutional size, trying to come in and access those products, access this liquidity, because now you have much more participants, much more economic activity happening on Solana. But they have very different needs when it comes to deploying capital. Those players, usually they have external money from LPs, and they have specific mandates, they need to generate specific returns. So they are very different from individuals. And so that means all the primitives we're familiar with today are not adapted to them most of the time. And what we've seen is all the activity on chain was mostly so far driven by retail participants and built for them. And so that means as an ecosystem, if we want to move away from this one-size-fits-all model and onboard more participants and essentially go further and grow as an economy, we need to first improve the models we have. So that's what we've started seeing with all those protocols on the credit liquidity side, trying to improve their models, but also we need to bring on new primitives for this on-chain economy and to gather to a larger set of risk profiles and participants. And so that's something we've been working on at Exponent, where we're essentially trying to make on-chain interest rate markets more accessible to a larger set of participants. Today, if you look at the yield landscape across Solana, it's very variable, volatile, and it's very hard for larger players to come in and to access DeFi yields because, again, they want predictability, they want to understand the returns they make. And so with Exponent, the goal for us was to make sure we could offer predictable rates to those players and better tools for them to explore DeFi and deploy across Solana. And so the way it works, you can see Exponent as a marketplace essentially for yields. Under the hood, it's a yield exchange where you can swap rate exposure. So if you want to swap variable yield exposure for fixed yields, you can do that on Exponent. You can also maximize exposure to rates if you're seeking higher returns. And so we're able to serve both ends of the spectrum. So on one side, we're seeing tons of participants looking for higher returns than they can get on existing protocols. And so they can go to Exponent and take on the volatility of those markets. And on the other side, there's a lot of participants looking for capital protection who can come in and get predictable rates on their positions. And as many other protocols, we've tried to go to market quickly. So we decided to launch on this AMM-based model, which is not the most efficient, but was a good way for us to bootstrap initial liquidity for our markets. And now that we're seeing meaningful traction, so as Pearce said, we have over 75 million TVL so far. We've been one of the fastest growing protocols this year. We want to move away from this basic model to something more complex, which is going to be built on an order book base, order book, and will enable essentially larger players to come in, to trade, to access DeFi yields, to trade interest rates, and to get fixed yield with larger sizes. I don't think we have much time left, so I'm going to try to wrap up. But to conclude, we're seeing really this trend of Solana DeFi maturing, more sophisticated players emerging, and also larger participants trying to come in. And we think there's a very clear opportunity here for builders, so that's more specific to builders, but an opportunity for builders to come in and serve those participants, because again, the ecosystem that we know today is not built for those guys, and protocols like Exponent make it easier and more interesting for them to deploy capital. We've seen many funds deploying capital through Exponent and interacting with protocols they wouldn't interact with otherwise because it's too volatile, it's too hard for them to price things like incentive programs, like points. And so they use Exponent to get better rates, transparent rates that match their risk profiles and positions. And so as a builder, you can really tap into that and help bridge the gap between TradFi and DeFi that we're seeing converging, and essentially be part of the next phase, of course, for Solana DeFi, because we expect institutional capital and sophisticated players to be a huge part of Solana DeFi moving forward, and less individuals. I don't think there's time for questions or anything like that, but you can follow us on X at x.com/Exponent Finance. You can also explore Exponent on our website at exponent.finance. And if you have any questions, you want to discuss about Exponent, how it works in the details, you can find me. I'm going to be around for a bit. Thank you, everyone.